I should have had like a theme, like a holiday theme, and got had everyone dressed like holiday gear, ugly sweater, but I didn't wasn't so, forward thinking here today. But we've been doing these Fed Day live panels for months. I actually look back, we started in June, so basically half a year, and a lot of insightful talks and conversation, and uh, we're really, I feel like we're building something nice in this little corner here on LinkedIn, and just kind of getting everyone's takes and thoughts and insights as it pertains to what they're working on. So why don't we go around the room, start with Augustus and then Andy, and then the other guys. Give a little background on who you are, what you do, what aspect of the markets or business world are you coming from, and then we'll get into it.
Sure, I'll start. Yeah, I'm Augustus. I'm founder and CEO of ShareScoops, which is a financial news and education platform. So focused a lot on the impacts on the consumer, making it sense for them, and we help financial professionals, advisors deliver messages to their clients as well. Before this, I was at JP Morgan, part of their outsourced chief investment officer group. So I was a multi-asset portfolio manager working with large institutions, endowments, and foundations, and institutional family offices.
Okay, great. Andy.
Okay, Andy Wong. I'm a managing partner and owner at Runnymede Capital Management. We are an independent and family-owned registered investment advisor in New Jersey, primarily working with individuals and families. And then we also work with business owners to help them with their retirement, their 401k retirement plans for their businesses. So I'm coming to it, I guess, from the perspective of working with clients and looking at what the Fed announcement and how that impacts client portfolios.
Cool. Thank you. Joe?
Yeah, nice to meet everybody. Joe Cox, co-founder, head of business development on the investment committee at Valmar Capital, a multi-strat, multi-manager with a specific focus on quantitative crypto strategies. So, we're very much in that sort of risk on category that's often affected by, these rate cuts.
Sure. Kruti, welcome.
I'm the unfiltered truth speaker,
Let's go.
an economist and statistician by training, and I keep a close eye on the general macroeconomic impacts of decisions that are made by the Fed or the government.
Great. Guy. You're on mute, or
Guy Berger. I always joke when I'm muted that I used my best material already. I'm a labor economist. I am senior fellow at the Burning Glass Institute, which is a labor market think tank, and I am a workforce economist in residence at Guild.
awesome. And my name is Ariel Serber. I focus on financial wellness and literacy. Actually started working at a startup literally in the last couple weeks called Oro. So it's a way to have employees match their health and wealth situations. So, but I also have been doing these lives and other content and some financial advisory for individuals and groups. So I come from a lot of different ways. So I think, obviously the rate cut was a quarter point, and now we're kind of at the end of, well, we're at the end of the year, and we're almost at the end of Chairman Powell's term. Maybe we'll start with Guy, because I want to talk about or hear about, the labor side of things. What did they say that piqued your interest? I mean, the quarter point rate cut was kind of signaled for a while. So, but did they say anything interesting, or that they actually have some more clarity than last time?
I mean, I think what's interesting about it is that, there's obviously disagreement on the committee, but Powell characterized the committee as thinking rates were within the range of neutral. If you look at what he said today, the statement, the projections, it seems like they feel like, barring some big change in the outlook, they are close to where they want to be. Like there's still over the next few years a gradual another 50 basis points of cuts, but they no longer see themselves as being wildly out of whack with where their policy is going to be in the long run, which I think is interesting. I mean, it's not clear to me that it is correct, but that's how they perceive it. Like there's no sense. Again, like a year ago or earlier this year, there was still this feeling of like, yeah, policy is restrictive. I mean, maybe not as restrictive as it previously was, and that even if in the short run it's adequately balances their two mandates, you know, they would have to eventually adjust it. And now they're sort of saying, barring some big changes, we are close to done. And there's no the I mean, again, I would assume the odds of another ease early next year are quite low based on that they're expressing that they think there's a very low chance of an ease early next year.
Right. Though who knows what'll happen.
Yeah, who knows? But like just where they're standing right now, what they're looking at, that's their perception.
Right. Right. And what about you, Kruti?
Well, I think
What do you think of today?
they're a dollar late and a day short, but I've said that for months at this point. So there is no news there. But I don't think that, given the dissent that I see within the members of the committee, and it's like a political storm almost of sorts that I see. And I think that we might see more rate cuts. Now, I know that the European Central Bank is thinking about hiking their rates, but then Europe is in a very different situation than we are in terms of energy and infrastructural investments that we have to make over the next so many years. And without the right rates, it would be very difficult for markets to be able to respond to more relaxed fiscal policy decisions. So we'll see.
Yeah. Joe, do you have any thoughts based on that, or?
Yeah, I probably know why you chimed in there. You know, I've been taking a little bit more of a cautious approach on rate cutting, right? You know, I think sometimes, and I'm not saying anybody necessarily here has this view, but sometimes people get it in their head that rate cut equals necessarily positive event. And I don't think that's necessarily true. I look at a lot of macro indicators right now and feel kind of weird. I don't know if that's like the hedge fund guy in me, right? I'm always waiting for something to break and to sort of take advantage of that arbitrage. But like, you know, if I was to just look at a few, you know, give me a second here, I can just pull up a couple major indicators that I was looking at earlier, which is like, you know, we've got the S&P at all-time highs, U.S. housing prices at all-time highs, gold at all-time highs, money supply at all-time highs, U.S. national debt at all-time highs. And, you know, at least according to previous CPI targets, right, you know, we're 2x, you know, the 4% per year since January 2020. So I wonder why we're cutting rates at this point into the face of all of those other integers, right? And, you know, I also often, again, not to get too trading oriented, I think about rate cutting almost like trading options to a degree, right? Which is like, you know, again, why now? Like if it does really make sense in a quarter or two, like more formulaically, you can always leg in later and it doesn't cost you anything. So that's just my view.
Right. Okay. Interesting. Andy, what are your thoughts?
Yeah, I think that today's move is what I'd call a hawkish cut. I mean, the Fed lowered rates, but it delivered that cut while waving a yellow caution flag. And what stood out to me is the level of disagreement inside the Fed, which Kruti referred to. I mean, one member wanted bigger cuts because they're worried about slowing growth. Two presidents wanted no cut at all because inflation is still too high. And I think that division tells us that we're in a very uncertain part of the cycle. The Fed is getting pressure from both sides of its dual mandate. So the question is, are you looking at a slowing labor market, or are you looking at inflation as we go into 2026? And I suspect, based on what Kruti was saying, that I similarly kind of expect that there may be more rate cuts than what the Fed is currently saying right now. Bloomberg expects inflation to reaccelerate to 3% by next summer. Quite a number of, I guess, analysis that I've looked at actually shows inflation possibly dropping to 2.75%. So I don't think that this is just about one rate cut. For investors, it's really about positioning what comes next. And I think with midterms looming and a new Fed head coming, today's move might just be the beginning.
Yeah, I think that last point is sort of the elephant in the room, where it's like they know there's going to be a new chief or head or chairman, I guess, in town. So, everything is kind of potentially hinging on that. Augustus, what are your thoughts?
Well, I'd be interested to hear more from Kruti on why you think, they're too late with this, or whether you think they should be, cutting more. But in my conversations, from a consumer to retail investor perspective, the things that they're most worried about, thinking about, is change. Like, when is something going to change from an affordability standpoint, from a wage growth, real wage growth standpoint? And this, I think, to what Guy said, is kind of the biggest takeaway for the average person, is that the Fed kind of sounds like they feel like they're done, right? That they're sort of, on track with what they're doing. And so where is that change going to come? We're seeing this massive, K-shaped recovery if our majority of our spending is by a higher income class, and it's a little bit more tied to sentiment in the market. Is this the kind of thing that's going to be more fickle from a economic standpoint, especially if we're thinking about what happens with AI and how much runway and timeline that kind of capital runway has.
And there's been so much plugged into that as an investment. And I saw just 2 seconds ago that Oracle missed, and all these companies are all tied together very closely. Kruti, do you have a response?
I do, but it might take a minute to explain. Just bear with me.
Yeah, please. Go ahead.
So we have to look at what is called the long run aggregate supply. And the long run aggregate supply, or the production in an economy, depends on its production possibilities curve. And since 2020 happened, our long-term aggregate supply, which is supposed, which as a developed country, first world country, whatever you want to call it, would be at a higher level, has shrunk, right? So it has shrunk. And while it was shrinking, one of the reasons why we see both higher unemployment and inflation, which otherwise would have been opposite to each other, is because we have moved from the long run aggregate supply to a short run model all the time. And part of it was caused by very rapid rate hikes by the Fed. And so all decisions that would have been long-term were switched to short-term decisions. And again, between all the political stuff going on with the government and the flipping around of policies, left, right, and center, has shifted up the aggregate demand curve. And it's almost like a bouncy situation, right? So this rate cut today is likely to bring back some of the production, but we are still below our production capacity. And with the technological, I think Powell mentioned it, that he expects to see more investment in AI and technology. Well, that aggregate supply curve, the long run, instead of moving, we would have been in a position to move it a lot farther had we been at lower interest rates for the last 3.5 years, but we haven't. And so we are now just struggling to first get to that point. Once we hit that point, we'll see a stabilization in unemployment rates and in the inflation rates. But until that point, we're going to see a lot of this uncertainty. And the reason is that if you look at the historical federal interest rate, we're way higher than what a typically well-positioned, well-producing economy should be at. So we need to kind of have a two-way tweak here, is to improve the production, the access to production, and on the other hand, play with that aggregate demand curve so that it meets the long-term production. I don't know if that helped, but.
So do you think that we basically sacrificed the long-term production by them raising too much too quickly and holding it
Yes.
up too long? You think should it have?
No, they had
is
no
there another way
business
to
jumping in like that. They had
Oh.
no business when the
Interesting.
whole economy was in a turmoil, and the government was responsible for some of the shutdowns and preventions of what counts as essential and non-essential during COVID. Instead of dealing with the root cause, they just slapped on interest rates like, well, that'll shake you out of your comfort zone, and that didn't help anybody. So we've created a short run, perennial short-term thinking instead of a long-term perspective on the economy. So
That
yes,
higher rates weren't the solution to the inflation problem.
No.
Interesting.
not the way they piled on each other.
Right. Well, I think Jerome Powell's, it'll stay with him forever was the transitory remark, right?
Yes.
So, anyone else have
Yeah.
any thoughts to add, or?
Yeah, I just have a couple of thoughts to spread around here. Ariel, I think you brought up a very important point that tied into something Augustus said, which is right, like maybe, and a few other folks that maybe this is the signal from this group, but this is Powell's last dance, right? He's on his way out. We don't know, how who the future Fed chairman is going to be. This is a non-pejorative political statement, but one would suspect that it would be a political ally of the president, right? Somebody who moves in line with the president's monetary policy. So I think the idea of an independent Fed is sort of like there's always some sort of influence on the Fed, right? But I'd really be interested to hear from everybody here, right? Like how they think about the change in Fed leadership having an impact.
Mm-hmm.
Did he freeze for everybody else?
I think, yeah.
Yeah.
How
he
the
froze.
Fed has operated.
Okay. Yeah, Guy, I know
So
we've spoken
anyway,
about.
I think you guys get my point, right? I'd be interested to understand,
Yeah.
what people's views are on, the shifting leadership at the Fed, right? And maybe perhaps very strong political influence playing a part in that.
I mean,
Guy?
I guess
Yep.
I'll say, well, two things. The first is I have sympathy for what Powell expressed today, which is that there was actually something really interesting that was there, which was people like to draw analogies to the mid 90s where the Fed, hiked very aggressively in 94. Some of us might be old enough to remember that, caused a giant panic in the bond market. And then they actually reversed course, I think because Alan Greenspan was pretty savvy and realized the Fed's assumptions on what full employment was too aggressive, and the Fed could let the economy keep growing for a while and the market keep heating up without risking inflation. And they eased a few times. Rates were still fairly high during a lot of the 90s, but they lowered them a fair amount. And somebody asked, "Is this like the 90s?" And Powell said, "No, I felt like the late 2010s were like the 90s, but I don't feel this way now, because unlike the 90s, where essentially you're just trying to give the economy room to grow without risking inflation, now the Fed's two mandates are in tension. They're simultaneously facing inflation that's a little too high, not extremely too high, but like above their target. And simultaneously, the labor market's getting weaker, not very fast, but it's moving in the wrong direction. And it's now past the point of where the Fed thinks full employment is. That is, their view is that in the long run, the labor market is actually, at some point, once they get inflation under control, they're going to have to reheat the labor market in order to bring it back to normal. Not by a lot. I mean, the delta is still quite small, by the way. But like, again, they feel like they're simultaneously being pulled apart by these two things. And they think that today's rate cut, along with the last two, are necessary for them to adjust to policy kind of straddling these two risks. What I want to say about the next Fed, that what comes after Powell, and I think this is sort of understated, is historically the chairman has been the most important, most powerful. And this is built into the institution because the person that came in had a lot of credibility with the rest of this committee. This was true under, and was very focused on coalition building. This was true under Greenspan. This was true under Volcker. This was true under Yellen. This was true under Bernanke, has been true under Powell. Mm-hmm. If you bring somebody in who essentially is battling against the rest of the institution, they are going to struggle to get the committee to go along with what they want. So that, the president doesn't get to magically get the committee to do what there's almost like a Carter call element here, which is feeling that Powell's some sort of magician that can easily get the rest of the committee. Powell can do this because he has credibility with the rest of this committee. Even then, people disagree with it publicly. We've seen this with the dissents and even the dot plot, the soft dissents. So I'll just throw out there that it is not going to, things can happen. Maybe a bunch of other board members resign, something the president can appoint a bunch of other people that are friendly to him on the committee, but it is not going to be easy, even if you put a Fed-friendly, president-friendly chairman in there to just for the president to guide monetary policy. The other aspect that I guess I'm not sure about, again, I always call myself a Fed dilettante because I'm a labor market guy, is when this new person comes in, they have to balance whatever they think they owe to the president versus what they think their legacy is going to be. You will say a lot of things to get a job, and then once you're in there, how much accountability do you have? I don't know whether all the people that are being considered, how likely they are to play as loyal. The president's term runs out in 3 years. Somebody else comes in. The Fed chairman's term runs past that point. They might care about their legacy. Do you want to be known as the Paul Volcker or Greenspan, not as the, Arthur Burns? All these things are going to weigh on whoever comes in. And so I don't want to entirely discount changes, but I think there's a lot we don't know about the dynamics of the committee after Powell is done. What if Powell hangs around? His term as governor is not over. What if he's hanging around and the replacement is new to somebody not trustworthy? Powell had a lot of influence in that committee as somebody who was trusted. So I just think, I guess I'm raising more question marks than answers, but I think it's not as clear cut as the president puts his guy in.
Right. And there's that level of, once you're in the seat, it does change you. Andy, what about for people's personal finances, if they're asking you questions about it and worried about their short-term, medium-term, long-term sort of outlook?
All good questions and great points by Guy. I think that it's worth mentioning that the Fed is in a kind of a rare environment. It's divided internally. It's surrounded by political noise. It's operating with incomplete data because of the government shutdown. And that's a tough backdrop for clear communication. I think that Powell has 3 meetings left before a new Fed chair comes in. And the front runner being talked about is Kevin Hassett. He's viewed as being more openly supportive of rate cuts. And when politics transitions and economic uncertainty overlap, the Fed tends to become cautious because it doesn't want its decisions interpreted as political. We'll see what happens. I don't know if the Fed is one and done or if there are more cuts that are going to be coming. But I would say that the bigger nuance here is that if we just look at today, it's like one cut. There's additional liquidity. And the Fed's decision to start buying treasury bills again, that's also meaningful for markets. It doesn't shorten the rate path, but it does improve conditions for risk assets at the margin. Liquidity sensitive areas like small caps, growth stocks, crypto, and even precious metals tend to respond well when the Fed is adding reserves back to the system. So I think I would ask Joe, given his spot trading crypto using a quant approach, like are you seeing the Fed as providing a tailwind for your strategy or a headwind?
Yeah, I think you just you have to look at that in different time frames, right? And so, I think a lot of folks in my industry, and part of my initial comments were maybe addressing that a little bit. A lot of my folks in my industry are consistently pro rate cut, right? Because of the perceived immediacy of the tailwind, right? That provides to risk on alternative assets and the free cash flow there. I guess my only, just putting my traditional hat on though, right? Like short-term liquidity is pretty cheap, and once that burns out, you really wonder about the robustness of what's underpinning everything. You're partly seeing that right now in the fairly recent compression of pricing and sharp reversion with respect to Bitcoin and everything else, right? You had this pump on enthusiasm driven by some cheap access to dollars and perceived activity by digital asset treasury companies, right, up to 125K. But it's really where's the staying power in that, especially if volatility is an underpinning aspect of the asset class and you are going to feel it on the downside. So once that gets that short-term liquidity gets ripped out, if there's not foundational institutional liquidity to replace it, to me it's worthless other than the short-term bump that it may give you, right? So I might predict, I mean, Guy, you said that remains to be seen, obviously, how the market reacts to this. I can tell you right now, the USD rates are down, but gold is down, USD is down, and Bitcoin is down. The market has not reacted immediately well. The only thing that I see up right now is silver sharply, which is usually not a great sign. Yeah, we'll see how this plays out, right? There's also the thinking, Andy, you have to wonder how many times does this data point hit before that pre-activity is already priced in, and you can kind of do away with that tailwind. So I less and less think about these things in terms of tailwind capacities. I more and more think about these things in terms of robustness of macroeconomic environment, right? Because as a risk on asset, we sort of need that macro stability for there to be overall stability in our asset class.
Yeah, thanks for that. And I don't think I answered your question, or I don't know if I did, Ariel. I mean, I'll just really quickly say that, I mean, there's been a wall of worry throughout most of this year, whether it was tariffs or geopolitical risk or political, confusion. And
Right. Or is AI going to take my job? Like that was
I think my message, yeah, AI taking jobs. I mean, my message for clients has been once some of the tariffs had been, brought down, the tariff levels, I say follow the market. Let the market tell you how are things. And I mean, the S&P is near highs. Small caps have hit new highs recently, and therefore I'm more bullish than bearish going into the new year. I think that hopefully the consumer is doing okay, and there might be some tax refunds coming back to people because of withholding. So I feel pretty good about the first half of next year. Visibility is limited. I don't know what happens in the second half, but we'll find out.
I pressed the wrong button. My bad. So, I know you have to go in a minute, right? So, can you tell us? I want to go around the room again and see what people are, thinking about, looking forward to, maybe concerned about going into 2026.
I'm actually looking forward to it. because the other alternative is not acceptable. But
Yeah,
if
you
we
have to be
don't
in
keep a positive mindset, we are never going to make the right decisions. So it's important to, I mean, that's what I would tell everybody. Yes, times can be tough, but we have two choices. We either continue moving on and doing the best we can to combat any uncertainties, or we just sit there and go, oh my God, everything's out of my control, which it probably is, but then at least you're doing something about it. So that's my takeaway for 2026.
Appreciate it. Agreed. Guy, do you want to go next?
Yeah, I don't know. Came in this year. Man, we're gonna miss Kruti. But I guess there's another meeting in January. I came into this year feeling pretty good about the labor market, and the first 2/3, leaving aside what I thought about policy, it was just an assessment of like the trajectory. And I think what has turned out to be is that policy has been less business friend and employment friendly and more disruptive in a lot of ways. And as a result, the labor market's in slightly worse shape at the end of the year than I thought it would be. And the trajectory doesn't look great. It does not look horrendous, but does not look great. And I guess my question is, what will happen now? Maybe these rate cuts are what sort of have now come in enough to like course correct and stabilize things. But I have far less confidence than the confidence I had a year ago writing a 2026 outlook. I'm actually not even sure if I'm going to write a 2026 outlook because I don't know. I've been so shell-shocked at all the policies that have come up that I don't know. Is the impact of the tax cuts we got this year going to eventually come in to offset some of the damage from tariffs? Is it, if the Supreme Court rules that the tariffs can't be collected, I actually think that's probably a boost to the economy because suddenly a bunch of money that I've been one of the people that's been relatively skeptical about the tariffs having much more than a short-term inflationary impact, because my assumption always is it's money out of people's pockets they can't spend. And now suddenly you're going to be giving the money, or at least no longer collecting the money. I don't know. But I think what I'm particularly curious about next year is, like, again, we've sort of been this pattern in the second half of 2025 of the labor market. After a while being stable is getting worse again. Hiring's coming down. Maybe layoffs are going to go up a little bit. At some point, if that doesn't change, we're in a bad place. And I'm assuming it will, but I don't have a lot of visibility to how far the current track continues before that stops. And I think that's sort of the big, as a labor market guy, that's my big question is like, how much worse is it going to be if you're a young person or a person lost their job looking for a job in 6 months relative to right now when it's already quite hard.
Right. And also just from the analysis part of it, we even have a BLS or whatever commissioner yet? I don't think so.
We don't. I don't know. The BLS is still doing their stuff, and frankly,
are they
they're just
releasing?
doing it. It's still, in my opinion, by the way, the BLS data is still reliable for the time being. There's no, I mean, what I would worry about with the reliability of BLS data is we have additional shutdowns next year that disrupt collection and publication. And B, like the BLS is massively underfunded. There are a lot of people that would normally be in seats aren't there. And less about, I mean, there may be, by the way, issues with data, like the reliability of data through interference later. But for now, my worries, again, are just like you're trying to fly an airplane and a bunch of the parts are missing. Periodically, somebody keeps turning the engine on and off. And
I don't love this analogy.
Maybe that's not but that's what we're talking about. Pick something less fraught than flying an airplane. But the point is that we are trying to do things on the cheap that are going to come bite us in the butt later on.
Right. You get what you pay for. Augustus, what about you?
For 2026, I think there's some cautious optimism. One thing I wanted to share is guys been talking a lot about the jobs market and AI, and there's a lot of different analysis on either side of whether AI is starting to have a material impact on hiring, or whether this is more sentiment driven and people putting more hiring freezes and this being a natural part. But I was just as a startup seeing a lot of where AI is really kind of eating into employment first. The average, I saw data from Carta that the median employment number for a Series A company or a seed company has dropped by 40 or 50%. So in just 4 years. So 4 years
okay.
ago, Series A company was about averaging 25 people. Now it's half that. It's I think 11 or so, and seed was 11 down to 6. And so you're seeing that kind of, that's one thing I'd, be a little bit worried about. But otherwise, I think the biggest thing that I'm talking to people about is there's optimism within the underlying numbers. And I think one of the biggest things that is changing currently and will have an impact next year is just the removing a lot of the fog of uncertainty. I think the administration has a real talent for creating uncertainty, but it seems like at least within the sentiment, within the questions, whether that the policies, tariffs seem sort of behind us to a degree, or at least relatively more resolved. And from business owners, you're seeing, hiring and revenue expectations start to pick up pretty significantly in the last couple of months. Just expectations and optimism, and even around consumers, starting to feel better, more stable. The top things they're worried about is no longer really the cost of living. Their inflation expectations are coming down. And if you look at, a lot of the numbers, there's reasons to be optimistic. I mean, in the Fed's report, it was they increased 2026 GDP from 1.8 to 2.3 and brought down their inflation expectations as well. And then you've got double-digit earnings expectations on the S&P, and I think 7 or 8% revenue expectation for 2026. So there's
Right.
when you look at the numbers, it seems like everything's pulling together to have a relatively optimistic setting from a top-down perspective on the economy. And a guy had a great note, I think, this week. It was, comparing the hiring levels to, when the unemployment rate was, almost twice what it is now. And it feels like that is a sentiment related, uncertainty driven aspect. It's a vibes. Yeah. So I think a vibe shift could have a pretty substantial impact on the economy next year.
Yeah. Well, as long as we don't have what was the line? Irrational exuberance. Is that the Greenspan line? So Andy, then Joe, and then let's wrap it up.
Okay, I'll make mine quick. I think what keeps me up at night in 2026, government spending. I think that the amount and level of government spending in the U.S. is not sustainable. But this is a global phenomenon. If you look at China, you look at Europe, you look at the United States, I think government spending, a high level of government spending, can explain a lot of GDP growth. And, I don't think that's sustainable. So that's one of the things that, keeps me worried.
For sure. Fair. Joe?
I'll bring it back to the positive side of things. Something I'm looking forward to in 2026 is continued regulatory progress, both in general in this country, but also with respect to alternative assets and specifically crypto, right? And that's, getting a true regulatory framework around what it is that we're doing. So there are clear black and white guidelines for what's on base, what's off base, right? And how everyone should be proceeding in a mature capital markets. That's getting direction as to whether or not it's the SEC or the CFTC, right? Really taking the helm here. And then it's, I think the continued bipartisan support of this development, right? For a while, I think the crypto legislative and regulatory issue had been largely breaking along party grounds, which is, not great to see, right? When, there's an emergent, evolving technology and asset class that can benefit a lot of folks in a lot of different ways. So it's been great to see both sides of the aisle coming together on this, and expect this to continue to happen in 2026, which should be the primary and one of the real catalysts of the asset class in general.
Okay. That's great. Anyone, just real quick, anyone doing anything interesting going into, Christmas, Hanukkah, New Year?
Making sure the market doesn't break, brother. That's all.
Oh, okay. Okay, not too much on your shoulders.
Just monitoring is all, and stopping
Ah.
positions if they need to be stopped.
Yeah. Be careful out there. Amazing. Anyone else? No? We're good. All right. Thank you so much. My hope is we keep doing these and, keep building and keep learning and keep growing and keep on, get more clarity on exactly what is actually going on out there, and also give people a perspective that they can trust and follow and build off them for themselves, their businesses, and all that kind of good stuff. Thank you so much, all. Happy holidays. Happy New Year. We'll all talk soon. Take care.
Thanks, everybody.
Thank you.
See ya.